Good afternoon, everybody, and welcome to the first in a series of Service Department News webinars. Today, we are going to be looking at investor sentiment towards the Service Department and extended stay sector. Before we progress, I just want to remind everybody that the entry period for the 2021 Service Department Awards is now open. Now, last year's awards were just over a year ago, and they were pretty much the last time the industry gathered in any significant numbers. And we'll be holding the 2021 awards towards the end of June. And it may be the first time that we all gather again. So we're just going to play a quick video to remind you what a fantastic event it is and to hopefully encourage you to get your entries in.
Welcome to the Millennium Gloucester Hotel for the 5th Annual Service Department Awards.
Very excited. We're up for 4 awards. Always fantastic. It's a great time for us to bring our team out as well. They work so hard. It's nice to get a chance for us to have a nice social.
Well, the best bit of today, I think, is just to mingle with the people of the industry. We are like a big family here.
We've had a great turnout. There's some difficult circumstances around the event and around the world, so we're really grateful for everyone who's made the effort to come here tonight, and we're going to celebrate the best people in our industry.
On with the business. It's now time to reveal the winners in the Service Department's Awards 2020.
It's a great honor to take this award. We're really proud and happy. It's been a collaborative effort from a lot of people, and so I can't wait to take this award back and celebrate with everyone.
I think it's imperative for the employment sector to have this kind of award ceremony that recognises the people that do brilliant things every day in the industry. It celebrates the excellence in our communities.
This industry is going through so many changes so quickly that there's going to be some exciting times ahead.
Okay, well, hopefully that gives you a flavour of what a fantastic event the Service Department Awards is. Feels quite strange watching that video. All those people so close together actually seems more than a year ago. It looks a bit odd, but it'll be fantastic to be able to do it again soon. Go to servicedepartmentawards.com to find out more and to submit your entries. So today's session will last an hour. We're going to have about a 45-minute discussion with our panel, followed by Q&A at the end. Please use the Q&A and chat functions to submit questions. We want to make the session as interactive as possible, and a recording of the session will be sent via email over the next couple of days to everyone who's registered. Before we start, just wanted to show a few interesting headlines from the last few months, just to show some of the transactions and investments that have been made into the sector in recent years. They're in lots of different countries. There have been individual asset acquisitions. There have been portfolio acquisitions, operating companies acquired. There's quite a bit going on. And here are a few more. A couple of really notable ones there. Staycity's refinancing, which included some investment from the Irish Sovereign Fund, and City ID and SuperAware's, APG and SuperAware's 500 million investment into City ID. And finally, I thought this was a good point to bring up before we start. The 2020 Deloitte European Hotel Industry Survey, which came out in November last year, found that service departments are the preferred option for European hospitality investors. So nearly half of those polled said service departments are the most attractive asset class, compared with 20% the previous year, with just 25% opting for hotels as the first choice, down from 31% the previous year. That just gives you an indication of the way sentiment towards the sector has improved recently. So now I'm going to hand you over to Ben Davis from Saxbury, who is kindly sponsoring this webinar and is also going to be your moderator for today. So welcome, Ben, over to you. You're still on mute, Ben.
Thank you very much, George. Thanks very much for handing over. So a little bit about Saxbury. We are a service department real estate agency based in London, and we have a nationwide reach. Our clients engage us to provide development consulting for proposed apartment, hotel and service department schemes, also to identify operators through targeted search and selection campaigns, and we provide funding solutions, including development finance and equity. And as George said, we're going to be taking a real deep dive look into why service departments in the extended stay sector is, as we believe, the darling of the investment class. So let's go straight to our panel. We've got a great panel here today. We've got Neil Short from Staycity, Development Director. We also have Mariya from NREP. NREP are investor, operator, developer of probably first mover really in the co-living space in the Nordics, and Mariya will be pleased to talk about the synergies between co-living and service departments. And we have Vedrana Riley, Ciel Capital, investors, operators, third-party operators of extended stay, and really big advocates of this for many years of this interesting asset class. So I guess we'll dive straight in and see if we can create a bit of dialogue between our panelists here. But actually, from a Q&A perspective, as we go along, any attendees are welcome to just send in the chat box here anything that you're interested in, or if you want to pick up on anything that the panelists have mentioned, and we'll try and find time to ask them here on the spot. But just to give a bit of context, hoteliers recently have faced a absolutely torrid time. I mean, it's been a world of pain for all of the hospitality sector, same in the extended stay as well. But many extended stay properties have managed to keep their doors open one way or another. Unlike the hotels with their small rooms that you can't live in and certainly can't cook in, extended stay properties across the country and throughout Europe have managed to remain open to some degree to house key workers, people who might be left here and they can't travel back to their home country, or people on essential projects. So that has been obviously a real lifeline for those that need the accommodation, but also for the operators as well. It's demonstrated a resilience in the business model that actually we've always known about, us in this sector. You know, this is a niche sector, but it's now becoming more mainstream, and it's now becoming more visible about the ability, I guess, for operators to be able to pivot to profitable models and remain cash positive. So with that, I'm going to ask Vedrana a question first. So I guess your company not only invests, but also asset manages and has properties operated in the extended stay sector. Have the past 12 to 13 months caused you to rethink your commitment to the sector?
I mean, picking up on what you just said, the past 12, 13 months have been very, very challenging. And it's been a lot of firefighting and closing and reopening properties. But what I would say is that we are still exceptionally committed to the sector. It has been a lot tougher to get deals off the ground, to make projects happen, and we're still looking and busy looking at a number of different opportunities. But genuinely, it has been much harder. I mean, as you know, when you appraise, especially a new opportunity, you always have to look at your base costs, and you have to look at your trading forecasts. And when the likes of STR and Hotstats tell you that it's going to take 5 years for the sector to recover, it is very difficult to then put pen to paper and say, no, it's going to be fine. We're going to achieve 90% occupancy, which extended stay is well known to be able to achieve. And despite having proven wrong, a lot of the STR likes, advisors and data specialists, by way of what we have been able to achieve across our portfolio in the UK, it is much harder, being very frank. And we touched obviously on the capital markets, for instance, and debt has been increasingly difficult. There is still debt out there, but it's, you know, it's on slightly different terms. It's more conservative leverage, it's higher pricing, all of which obviously make it more challenging, let's put it that way, but we're still very committed to the sector.
You're on mute, Ben.
1 second. Yeah. Okay, so that's good to hear. So you would say that the capital markets are still there for the extended stay sector?
I think it's fair to say that a lot of the banks have retrenched, and not because they did not want to lend, but just because they focused on supporting their existing clients who have needed help, you know, through CBILS and all the various government initiatives. I mean, it's primarily been CBILS and also overdraft facilities and things like that. But yes, I mean, whilst that has dried up, there is still debt out there on slightly different terms. I would say that this is also a very favorable market to pref equity and mezzanine style lenders, who obviously command much higher returns, but who are still very much back in the market when it comes to hospitality.
Okay, and have your properties remained open during the pandemic?
It's really been market specific, to be honest with you. I mean, we have extended stay as well as obviously more traditional hotels, be it, you know, more limited service on their asset management. And I would say that the majority of the properties we've kept open, or we have reopened, actually, I should say after the first lockdown as quickly as we could. I mean, Waterloo, for example, you know, we shut down in line with government guidelines when it came to the first lockdown, and we reopened it sometime, I think it was May, June time. And, you know, across the board, even if it has been really, really tough, Waterloo has constantly exceeded what the London average has been. You know, midweek, we've always kind of remained at circa the 50% mark, which we're quite happy about. Obviously, weekends have been a lot more challenging because throughout most of 2020, we weren't even allowed to sell to leisure, and we still aren't allowed to sell to leisure. But yeah, Waterloo has been very resilient, and obviously the way that property works as well is very reassuring. We have obviously self-catering property, units really. But Manchester, for example, has just, it didn't make any sense for us to keep Manchester open. But then, you know, there are, like, on the asset management side, there's a limited service hotel in Ramsgate that is currently at 80% occupancy, and it's just absolutely incredible. And that's purely because we have, you know, the police in there.
So, okay, thank you. So, Neil, those in the know that service departments is a defensive asset class. It's what we've been banging on about for many, many years. How have Staycity's properties really performed during this rotten period for hospitality sector?
Well, as you know, Ben, it's no disguise that 2020 was an exceptionally difficult year for anyone in hospitality. We spent probably 90% of our time doing things we never anticipated we'd be doing at all during the business. We had a bit of an early warning system, in as much we traded property in Venice, and Italy, if you cast your mind back to March, was one of the first affected areas. So that very quickly went to 10% occupancy. Once we saw that coming up on the radar, while everything else was trading okay in Northern Europe, we thought we had to take drastic actions pretty quickly. And there's a variety of measures that we took, which was reducing staff, putting hotels on skeleton staff, ceasing capital expenditure, unnecessary travel, shareholder dividends were frozen, a whole raft of measures while our UK and Northern Europe estate was still trading okay. So we got ahead of the curve a bit. We also pivoted our booking stream. So we quickly went to large government and health authority organisations to see if we could get large contracts to get our properties let to them, because we knew OTAs and leisure business and business spend was coming to an end for the foreseeable future. So fortunately, because our product is quite socially distanced by its nature, it's got kitchenettes in there, it's got dining areas, it's got workspaces. There's lack of social contact. If you like that at breakfast, you don't have to go down and meet other customers. It's not laid out there. You can do everything you want in your room. Local authorities love this, so they quickly snapped up a lot of our properties. And although we let these at a much lower rate to what we would normally let them, if you're getting a good amount of occupancy, in some cases 100% occupancy of your units last year, you're doing fantastically well. So we kind of came to some good agreements. Dublin especially, we had a good few local authority contracts. The way the year panned out, I still can't believe I'm saying this is a good thing. We ended up 2020 with 50% occupancy. If you'd have spoken to anyone in hospitality before March last year and said you're going to have 50% occupancy and be happy with it, you'd be laughed out of town. But we came out with 50% occupancy and we were very happy. So it was a tough year, but I think we pivoted really well. Our product fortunately lent itself to the pandemic, and that benefited a lot, especially against hotels. I know a lot of hoteliers, and Vedrana mentioned it, they were down to sort of 20 and 30% occupancies if they're open. So as I say, to have 50%, we were quite happy.
Yeah, I bet you were. I mean, I think that's proven that Staycity is it has an agile business model, but I guess it's just a ringing endorsement for extended stay in general. Just the agile nature of the product, the fact it can pivot to to accommodate all sorts of different needs, pretty much underpins the investment case. George touched on it earlier. You received sovereign wealth investment in the business last year. I mean, this is obviously big news. I guess big news for you as a brand, but again, I would say that it's probably a ringing endorsement for extended stay in general. Can you tell me a bit more about how this came about and what the outcome is?
As well as sort of, I've just gone through a lot of cost-cutting measures, which you want to get down your fixed costs as much as possible last year because your revenue stopped. And you've got in apart hotels, you've got lower fixed costs than the normal hotels. At the same time, and every hospitality business would have been doing this, you need to increase liquidity because suddenly your revenue stopped overnight, and no matter how many fixed costs you stop, you've still got a lot of fixed costs such as rent, service charge, insurance. They still have to be paid. So we went out probably June, July last year to raise some equity to provide for the business to keep paying the rent and all those fixed costs that we have. This is the height of pandemic in sort of June, July. We were bowled over by the response from private equity. We had 15 solid offers. These weren't offers for a distressed asset. They were kind of once in a 10-year opportunity to invest in a private company. We quickly whittled down to 6 and then had 6 presentations from private equity houses. And we identified ISIF, which is the Irish Strategic Investment Fund. Easy for me to say, don't get it mixed up with ISIS. They invested in us. We identified them as the preferred partner from day one. Their mantra is champions of the Irish economy, protecting jobs and protecting commerce. They're less vulture-ish than most PE houses. And to have a sovereign wealth fund sit on your board, what company is not going to like that? Don't get me wrong, this took months to put in place, and it was about 4 or 5 months of my CEO and a big part of the team's time to sort that out, and it took about 5 months, but we were delighted. And it's left us in a very, very cash-rich position, which is ironic, considering what we've been through last year. We're probably the most liquid we've been in our history. So a lot of that is to see what happens to the rest of this pandemic, but we're sitting in quite a comfortable place at the moment, Ben.
Well, that is a very positive news story. I imagine that you had multiple investors kind of knocking at your door pre-pandemic. So perhaps this was a moment for you to have a quick think among the board and think, okay, now is the right time.
Yeah. There was often calls I'd be involved in, meetings I'd be involved in, where there'd be unsolicited offers for parts of the business, but we like to pick and choose who we have on our board, and every investor in the business is on our board. It's a privately owned business. It's 60% by the Walsh family, and they want to have good bedfellows that add value to the business, and they're not just taking a slice on the back of growth. They've got to play a part in the growth as well. So everyone on our board plays a part in growing the business. They've got to add to us as well as just taking a bit of the business and see us grow.
Of course, yeah. So thinking about how I guess all operators have had to pivot to accept long stay or to focus more on a long stay model in order to remain cash positive. Mariya, so NREP is a very large organisation with significant exposure in the Nordics. You might say maybe a first mover in the co-living space. Which I think might be an interesting segue into co-living, because co-living is predominantly extended stay or long stay for longer term residents. But I guess there are some synergies or some parallels between your model and maybe a service department model, Mariya. I'll be really keen to hear what you think they are.
Absolutely. Well, in my opinion, I think we can look at serviced urban living as a whole, and of that we have several different concepts that are targeting specific customers, of which NOLI, which stands for Nordic Living, is targeting the younger, maybe 25 to 35-year-old population, where you provide essentially an affordable service apartment because of its smaller size, but ultimately you provide all kinds of services on site with an ability to adjust those depending on whether that's a short stay or whether that's a longer stay. So we typically have a mix of around 80% longer stays, so more than 9 months, and 20% short stays. Different co-living brands have different concepts. So I know there are some that even resemble service apartments even more than us, because we're slightly more focused on the longer term stay. But ultimately it is a service living model, and it is a relatively flexible living model. So of course it allows you were talking about flexibility earlier and agility to change your operating model depending on what a given situation asks for. So of course, I think co-living assets were a bit more resilient during the crisis. We were lucky that we were fairly early on in our growth journey of NOLI. So we have only 2 operational assets in Helsinki, in Finland. We are developing some assets in Copenhagen, in Denmark, and we are looking to grow across Europe. But our 2 operational assets performed quite well, actually outperformed even a bit the business plan. So we had more than 80% occupancy throughout the crisis. And it is partially because I think, of course, we were lucky that we're in the Nordics, so they had a slightly different approach to lockdown. So some of the assets remained open, and so did the amenities that the assets provide. Whilst in the UK, co-living operators had to shut down the shared amenities and service that they're offering. So I think when thinking about the future, people will want to have those type of services close to their home because of the nature of how work will change. So I think service living is indeed a growing sector, and the ability to change your model. So our assets don't really differentiate in terms of product between short lets and long lets. So even if you stay for short lets, you do have the same amenities as a long let. So you could pivot, for example, in other times you could pivot towards a slightly bigger percentage of your revenue towards short lets, because that's a revenue booster, because you can charge higher rates for shorter duration. But I think that's the beauty of the sector, that it allows you to sort of shift between long lets and short lets. And of course, from an investment standpoint, the short lets are perceived as a riskier asset class because you have shorter lengths of leases. So in theory, you could become, your revenue can drop quite significantly. So when you look at investment yields, co-living kind of sits in between the residential sector, which in the UK is around 3.5%, and the hotel sector, depending on whether you're taking operational risk or whether and how long your average stay is. It might be anywhere between 4 and 5%. So co-living probably sits somewhere in between around 3.75 to 4%, depending on, of course, location and operational risk and length of stay you're taking.
Okay, so you're broadly, as a business, you're happy and you're committed to operational risk because you want to be able to retain that fact.
Absolutely. So NREP as a business is of course primarily a real estate investor and developer, but we have started to also create operational verticals which focus on different asset classes, and NOLI is our own brand. It sits outside of our real estate investment, so it's actually fully owned by the GP, by NREP as a company. So we can control that, but also work with other brands when we're growing. So we do think that there is obviously a lot of synergies between the operational side and the real estate side, because as a real estate investor, you're helping the operating business grow, and the operating business, it's all about scale. So I think the challenge that a lot of co-living operators are facing, which are asset-light operators, is how do they actually scale? Because it's only at a scale that you can generate and be profitable because of the low margins of the business. And at the same time, understanding the operational side allows you to create a targeted product as a real estate investor and developer. So we absolutely see the synergies between the two. And when we're thinking about growth, we're thinking in terms of both. But it also, I guess, allows us to have a bit of a flexibility when entering new markets, to partner with different brands and not necessarily just focus on Noli, which has been our choice in the Nordics so far. As I mentioned, we have two in Helsinki, which are operating under a commercial lease, so the same as a hotel. Whilst, for example, in Denmark, we're operating as a residential zoning, so more as a longer stay. In the UK, of course, you have quite complicated planning rules about these things, and that's why co-living, I think, might have struggled to grow as much in the past, despite the fundamentals being there completely in London as an international city. But I think planners are starting to be more comfortable and understand these models, and are starting to grant planning permissions, even with sui generis, which is obviously sort of the preferred planning permission for a co-living place, because it allows you to be absolutely flexible with your length of stay and size of units.
So Neil, hearing that, I mean, understanding that the increased yield, you know, keeping all of that profitability in-house, being an opco and a propco and a developer and investor and operator all in one, does that not inspire Staycity to maybe do more than being an asset-light operator, you know, maybe taking development risk or anything like this?
I think our long-term goal would certainly be to own freeholds. They're very, very cash-heavy things to do, though, especially the markets we're in, the Londons, the Edinburghs, the Berlins. You're talking tens of millions of pounds, and your growth would be at a snail's pace if you were funding each one of those. Asset light allows you to go quickly. If you're taking an operational lease and you're using developers and funds, institutional funds money, it enables you to scale up at a much quicker rate than you're organically growing your own cash. We have dipped our toe into the development market. We've done one recently in Paddington that opens this year. It's 250 bedrooms on the edge of Paddington Basin, fantastic location. And it's a site where, to be honest, they've probably done the rounds around the market a couple of times, and it was slightly tarnished when it came to us. And I think it's one of those sites that everyone sees and thinks, not that one again. We had a good look at it. I think we bid on a leasehold basis a couple of times, and we kind of started to get under the skin of it and realised that there's a development profit there. And if we recycle that back into our rent, we can make the thing stack up. So we took an option on the site. It was consented for a Mariya, for a 600-bed Mariya. We took an option on the site, which was a bigger site than we needed. We altered the planning on Section 92, brought in Premier Inn, Whitbread lease, and they took 320 odd beds. A lease back to ourselves of 250 beds, and there was a school on the side as part of a Section 106. So it's a big development play and a big ticket for one of our first entries into the market. But touch wood, we fortunately got that away and got the planning, and we got it forward funded by M&G. And it was a 200 million GDV eventually, and we're going to open that this year. But what it did enable us to do, even though we're out of it and we won't ultimately own it, we will recycle the development profit back into the business. And that's helped us last year through COVID to have that ring fence money coming in. And it'll also ultimately enable us to lower the rents. So you get a higher rent cover ratio as a consequence of using that development profit for the operational business, and it doesn't disappear off to a developer. Having said that, 80% of our business, 90% of our business will be developer-led, so I've got no issue with them taking development profit on sites. It's just there's the occasional opportunities where we'll develop ourselves.
Okay, I understand. So just on, you mentioned lease, just touching on that. I mean, going forward and coming out of a sort of post-pandemic world with risk-averse investors, and I guess with this desire for you to keep on growing your brand, I imagine that your leases or your lease proposals would have changed somewhat since pre-pandemic, mechanisms, structures. I mean, is there a way or maybe how are you helping investors and developers get to that all-important GDV and investment yield? Because I imagine that you've probably tinkered with your offers.
Yeah, fundamentally, we're still offering fixed leases, and that we take operational risks, developers take development risks, and funds take risks in the business that they have the underlying asset of the real estate. As of last year, I mean, we're signing up to 25-year leases, and as Vedrana touched on earlier on, you need a long line of sight of what your trade's going to be able to commit to that. And with STR shutting down overnight, you're kind of sitting there with your finger in the air sometimes thinking, where is this? How are we going to price it? So at the height of last year, we were tinkering around the edges of what we do at our leases to kind of blur the lines a little bit between operational risk and development risk. So I touched on the deal we did with Saxbury, where you represented the owner in Liverpool Street. Great site, 6 beds, hopefully, that's going to open within 100 metres of Liverpool Street. Close to exchange when we're going into the pandemic. Pandemic hits and the wheels come off the economy. It's difficult to price. So what the collaborative agreement we came up with the developer and yourselves was to reduce the initial headline rent, but then have a turnover top up. Now this protects everyone in the game, because we don't know what we're going to go into in terms of how quickly COVID is going to recover. It will recover. It's such a great spot in central London, but we don't know how quickly. So we have a soft landing, if you like, when this lease starts by having a lower rent. However, if there's a steeper trajectory in recovery, the landlord benefits by having turnover top-ups. So it's a deal that worked for everyone, and underpinning it all, there was fixed uplifts at rent reviews. So eventually, after a period where we and the developer are comfortable, we'd be able to return to normalised trading in 5-10 years. The lease then reset itself back to where we originally agreed terms. So it's a very equitable and sensible deal. It's balanced, and it gives everyone confidence they're signing up to a deal and they're going to be able to meet their commitments.
I would completely agree with you, Neil. And actually, just to say that Staycity acted so honourably throughout the whole of that process. And I think that this was a time when nobody really knew what was happening. Your comment about the wheels falling off the economy, I think everybody's mouths just dropped when, we're holding what we were about to ink a deal with Staycity, and I think in some respects we were probably expecting an about turn, but it was a very calm, measured process that we went through, and I think it kind of shows that obviously Staycity's commitment to the sector is long term. Same with our developer and investor. He sees the long-term value in this, and certainly as the investment yields and the cap rate will sharpen and compress over time, probably 2 to 3 years following the opening of the site.
It was nice to be working on new developments last year. It was a good relief, which that's what we do all day. But last year was different, so it's nice to be doing that. Thanks, Ben.
Yeah, and Ben, just from a sort of investor developer perspective, there's always been, of course, maybe 100 basis to 150 basis point difference between whether you take a lease with a good covenant or you take a management contract and somewhat operational risk. I think personally we'll see that being squeezed, because the majority of operators will probably not take pure leases anymore, and at the same time, investors will realize that in times like this, it's really quite impossible to do anything about it. I mean, you won't be able yourself to fill it up and create any better revenue than the specialist operator. So I think over time, I think institutional investors will just have to become comfortable with underwriting some sort of operational risks, because also having an asset light covenant is never going to be strong enough necessarily. Yes, you might have some sort of guarantee or deposit, but it will never be the same, perceived the same. And I guess I just wanted to mention from the co-living world, one of the biggest names, Quarters in the US, they had quite a lot of scale picking up, but they had to file for bankruptcy. So you never know whether anyone is too big to fail. So that's why in the future, I think the operational and real estate side will have to start working together a bit harder than the past.
And picking up on your point, 100% agree. I think what the markets and the investor markets have really realized is that lease or no lease, whatever your management structure is at the end of the day, these are all operating assets. And, you know, some landlords, going back to Maria's points, have been less forgiving than others. I think Neil, your side of the table has been quite fortunate with some of your landlords from what we've heard, but you know there have been some landlords that have been a lot more unforgiving, and I think it will eventually reflect positively. And I think we're already seeing this, is that, you know, the franchise market, you know, there's a lot more appetite for that. There's always been appetite for franchised assets, but I think that market will grow further, because underwriting lease, back to Maria's point, you know, has become a little bit more challenging. Although institutions, let's be frank, will still always prefer a lease.
So Vedrana, I was going to ask you, obviously we were talking about sort of new developments for operators, but I guess there are huge opportunities, you know, lying out there in the conversion of existing real estate, maybe shopping centres, first generation offices, that sort of thing. Would you say that it no longer makes sense to do ground up developments for extended stay? You know, should there be only a target maybe in refreshing older assets?
What I would say is that what the capital currently wants is quick wins. You know, most of our investors and most of the PE houses we work with want quick wins. Everyone wants to buy cheap, add value, redevelop quickly. You know, it's all about the speed, because everyone's internal rate of return driven. It's not just about the profitability. So I think that's probably what's driving the conversions more than the actual, you know, the ground up developments are no longer for anyone. I think it's really the timing factor that's dictating it. I mean, my personal view is that a ground up development is actually much easier to underwrite, because you know, the surprises you're going to find when you start ripping out floorboards and taking off the plaster are just, you know, could sometimes be very immense. You could end up with progressive collapse in the building, and there's no survey in the world that's exaggerating, but, you know, no non-intrusive survey in the world that can actually give you that level of detail. And so, no, go for it.
I was just going to say, from an operator point of view, we much prefer ground up developments. You get a much better product. Although conversions can be cheaper, I don't think there's a huge amount in it, but they can be. It's a far better product with ground up developments, new builds, than it is conversion. Although, as I say, there's a cost difference. Have you ever? I was going to say.
Yeah, and the gross to net as well with conversions is the problem sometimes, because, you know, you're trying to fit a product within an existing structure that may not necessarily fit. So, I mean, there are a lot of challenges with conversions. That said, you know, if you do have a very clean office building with like really nice floor plates and sufficient windows everywhere, which never happens, you know, it is a lot easier to redevelop. But yeah.
So and to that point, I think there is also one question around ESG, and that's where I wanted to jump. Obviously, conversions from a sustainability standpoint are a lot better from embodied carbon standpoint. But sadly, I mean, at NREP, we're very committed to sustainability. We see that not just as a nice thing to have, but genuinely as a commercial opportunity to be different and to create higher profits. So in an ideal world, we would like to retrofit, but some of the products that we're trying to create, as you say, Vedrana, it's very difficult to find an existing building that suits, whether it's floor to ceilings or whether it's column grid, and so often it also becomes more costly from a financial standpoint if you're going into deep retrofit. But also on the point of sustainability and the short-term view of a lot of PE firms that you mentioned, Vedrana, yes, people are driven, but having a long-term view is quite important from a sustainability standpoint, and also the ability to capture any efficiencies in terms of sustainability as a essentially profit reducing costs. So that's one of the reasons why at NREP, for example, recently we raised not only an opportunistic fund and pot of capital, but also an income core plus fund that can have a much longer view. Even though our opportunistic fund is already longer than what traditional PE houses have, so it's 10+2 year hold, but at the same time we saw that we really need to have that long-term view also when we're developing different operating verticals, operating brands. We again need to be able to scale up to see the efficiency of scale really playing to our advantage. So that's also from a sustainability standpoint, again, having the operation and the development side linked up makes a lot more sense, because you are the one that is taking advantage of for example, and return on investment in terms of sustainability initiatives.
Vedrana, you're picking up on it, sustainability. Your extended stay property in Waterloo, the Stowaway, which is really great concept, actually really great design. I would say it's a really good example of sustainability in development and hopefully in operations too. What drew you to this project?
I mean, I've looked at that project on and off for a number of years, and our partner in Stowaway, our JV partner in Stowaway, was really the brains behind the original concept, in relation to reusing those shipping containers. And he always felt very strongly about, the ethical side of things. And I must say, it took a lot of effort and passion to make that concept work. And I couldn't be happier that we did, because I said for, what is effectively a 20-bedroom property, it's a bit disproportionate, the amount of time and effort it took to get it off the ground. But the result is exceptional, and we are really happy with it. And going back to Mariya's point of earlier, when you are doing a new development, even if you're using existing materials, i.e. you're recycling, shipping containers that have been used once before, you can still continue to incorporate elements of sustainability. We have solar panels on the roof. We've got an energy contract, with a renewable type provider and things like that. So there are lots of things, and a lot of the big brands have recently come out, or recently-ish, over the past couple of years, with we're going to use less plastic and all of those things. And I think from an operational standpoint, there's so many things that a lot of people have been lazy to do, that COVID's made very difficult as well to continue implementing, like miniatures, for example. It's obviously much easier to have miniatures also from a COVID standpoint. I mean, I was shocked when I went to a restaurant and I was given a bowl with like little bits of salt and little bits of pepper, and you really want to cry. It's like all of that plastic and paper completely wasted. But going back to basics, I think there are a lot of things that one can do operationally, across the board, not just at Stowaway, not just at Staycity, where by using larger containers, for example, it's not just a cost matter, it's generally an ethical matter, trying to minimize the amount of plastic and all of those things.
So Mariya, you mentioned before about the co-living sector and some of the M&A activity, that you've observed, and I guess again perhaps it's more of an endorsement of extended stay. Maybe it's co-living, or it could just be perhaps some operational business models weren't necessarily that sound in the first place, and they're being more absorbed and taken over by solid investors and more credible brands. But I mean, maybe you can talk us through some of the things that you've observed over in continental Europe.
Yeah, absolutely. So I think what happened with COVID and co-living is that co-living was still quite a new sector and in the developing sector when COVID hit. So it created a pause in the sector, and people started getting ready for what happens after COVID, and maybe as a difference to some of the longer existing sectors like extended stay, they didn't have to fight fires, a lot of them, so they could think more strategically how to position themselves for after the crisis. So I've seen two types of trends. So on one hand, there have been a few fundraising and joint ventures from a real estate perspective that are focused on targeting co-living, and I guess just to name a couple, Node Living raised 300 million at the end of 2020. Ivanhoe, Cambridge Bioinvest, and Greystar formed a JV, not only for co-living, for student housing as well, but still a 1 billion JV for a Parisian co-living and student housing concept. So we see quite a lot of those, and maybe some of them partnering also with a resi developer that has experience in residential real estate, but hasn't really pioneered micro living or co-living. So for example, Aberdeen Standard and Island Group, again, targeting over 5,000 micro apartments across the Nordics. So we've seen that on one hand, and on the other hand, as you mentioned, quarters, we see operators, asset-light operators consolidating. So quarters after their, I guess, not so successful expansion in the US, where actually they sold their European business to Habit, which is a competitor of theirs. And we see quite a lot of venture capital money being poured into asset-light operators, as you said earlier, Neil. Of course, it's a lot easier to grow being asset-light, so venture capital is the natural source of capital for these higher growth ventures. And so, for example, we've seen other examples. Common in the US is the biggest co-living operator. They've raised quite a bit of fundraising. So I think the next step is really kind of marrying the two activities together, and again, getting the real estate investors to talk to those operators and help them grow on their journey of growth. And maybe we'll see more partnerships between asset-light operators and real estate companies coming in the future.
Yeah, I mean, it's all terribly positive. I mean, if I actually thinking about Staycity, for example, George had told me only yesterday that the interesting fact is that the most amount of hotel keys that are opening up for any one brand in the UK is Staycity coming up now. So is this all you?
I would like to claim full credit, full credit and full bonuses, but no, it's not all me, unfortunately. We've got an incredible year next year. It's really interesting times. I mean, our estate, we're about 3,000 bedrooms. We're the biggest independent apart hotelier, but in the grand scheme of big hotel companies, we're small, but we've got 3,000 beds in 23 locations. This year, we're opening up 10 new properties. It's going to add 2,000 beds to the estate. So this is a sea change in Staycity this year. Fortunately, we've got some decent rent frees to see us through whatever might be happening this year, and they get a bit of a cushion, the new hotels that are opening. But there's some great locations. I think we're opening, I'm pretty sure this stat's correct, we're opening the most beds in London next year, hoteliers or extended stay. Other openings are in Edinburgh. Germany, we're trying to increase our footprint as much as we possibly can. So yeah, I mean, this is work that was done 2, 3, 4 years ago that's coming to fruition now. So the next 2 years is going to be rapid expansion. We're looking to catch up on what we didn't do last year. So we think there'll be quite a few opportunities that probably aren't there yet, but I think they're beginning to peer their head up in terms of not quite distressed, but opportunities that we wouldn't have seen before. They're now becoming viable. So we want to fill up that pipeline that we missed out on last year and hopefully have a good year in 2024, 25, I think we're looking at when we sign deals now.
And yet the European extended stay market is still undersupplied relative to US and APAC. Vedrana, how much growth do you see over the next 5 years? And I guess will the institutional investors see this as a staple for their portfolios?
I think that talking about just development, I mean, the UK still has quite a lot of, it is a market that's still very, very fragmented. You know, even the global brands, that have extended stay, like the Staybridge and the Residence Inns of the world have very, relatively limited presence within the UK. So talking about potential, there's a huge amount of potential, and extended stay as a whole represents still a very small percentage of the overall, hotel beds within the UK, compared to obviously the US or markets that are more mature, like Australia and Asia Pacific in particular. But I think I would say the pipeline is probably going to be hindered a little bit by what's happened. And I think while institutional appetite is still very much there, and I would say probably the private equity houses that have been largely absent over, I would say, probably 2019 are probably going to be the first ones to come back. and to start developing and adding value and adding keys. I would see the institutions following through afterwards. There may still be a number of lease deals, for example, but I think there's still a little bit of way to go before the much larger institutions get the confidence and gain the confidence again to be buying like franchise management paper. So yeah, I would say probably within the next 5 to 10 years, 100%, would be kind of my personal forecast. And hopefully it will happen a lot faster. But yeah.
Yeah, I guess.
And just to add to that, I think that institutional investors have raised quite a lot of capital, and from an asset management perspective, real estate is becoming a bigger asset class, and more money is being poured into real estate just because of the lack of other yielding asset classes. So with that, obviously we've seen quite a shift in the yield profile across Europe. Maybe the UK has remained somewhat consistent because of some of the recent events in the last few years, but as a whole, yields are shifting down, and especially in the residential sector. So as institutional investors are seeking higher yielding assets, I think they will come out to understand and move on towards extended stay as a first, and then hotels later on. So I do think that institutional capital is coming along the way. It's just it will take a bit longer than the PE firms, as you say.
To add to that, I'd also say that retail money has got to find a new home. I mean, there's structural changes in retail. That is not bouncing back quickly. We're all very comfortable now ordering online and getting deliveries. So once the problems are sorted out in retail, that money has got to find a new home. And with hospitality, you still need bricks and mortar. And is it going to be diverted to hospitality? That's my theory. And I think you'll see a lot of money flowing from retail that will divert into what's always been called the alternative of hospitality. Well,
so we've got about just over 5 minutes left. I don't know where the time's gone. I've had a question come through from one of the attendees, probably best for Neil. Do you think that the turnover leases or some form of lease and top up will become more common in the future? And now, do you think this will be set in stone?
I just speak from our side of the house. I think this is probably a short-term thing. I think while there's uncertainty surrounding trade, you don't know when it's going to recover. You're not quite sure how quickly everything's going to bounce back. We think leisure is going to bounce back quickly. You're not sure about business. While there's those question marks that are still around, I think there will be looking to be some sharing of the risk with the developer. I think once we're over the bump, and hopefully we do get over the COVID bump fully, I think then there'll be fixed leases will come back in, and you'll be more certainty about how you price, and we'll have a bigger estate personally to price, which gives you more comps. So I think there will be in the short term, but I think for operators who were asset light and did leases previously, they'll return to that model, and I think it'll be very well sought out by funds.
Makes sense. Thanks, Neil. Mariya, probably one for you, from Steve Lowy from Lowy Group. Do you think that the complicated planning conditions in the UK will restrict innovation with uses like co-living and apart hotel service departments?
I guess a short answer, I think they have restricted it, even though the UK is one of the most, in London specifically, established co-living markets. I think because of the nature of its demographics more than anything, I think the planning system indeed has restricted some of that growth, because we've seen that Germany, for example, is a much more established micro-living market, maybe not to the same extent of service level offer, because there are lower levels of services. German planning system is a lot easier because it doesn't restrict the use class or the length of stay and the size of the units. But we are seeing in a lot of the local plans already co-living being introduced, and sort of local governments taking a specific view. So I think even though I haven't really updated myself in the last few months, I do think a lot of them are starting to think of how they can make it more predictable. And as we know, the most recent planning changes don't really make a difference in some of the use classes. So as you know, they've simplified it or tried to simplify that. So even though these are not in use just yet, I think we'll see the UK planning system moving into a bit more of a zoning type system as is the US and Germany. So that will improve over time.
Okay, great. I'm being nudged by George to hand back to him. There's one quick one, and maybe Neil, if you could try and answer this very quickly if possible, if it's something you get. Question from Giacomo Silvestri. Temporary automatic rent adjustments. Have you been putting in force majeure lease clauses and so on? I guess I think Giacomo is probably interested to understand if temporary measures might ultimately become structural clauses in leases, and you know, whether or not these are really going to appeal to investors long term.
I like the sound of it. It sounds like you can flex your lease terms downwards if there's a problem. We haven't employed it, unfortunately, but yeah, more than happy to listen to the structure. It sounds like it gives a bit of flexibility. I don't know if they're going to, how can they stay low forever? I mean, there's a period of forbearance that the government have put in and landlords have to use, but I'm not quite sure how a tenant can forevermore have lower terms unless it's by consent of the landlord. And
I'd have to completely agree with you. I mean, when I brought things to market last year, this year, I'm seeing a lot of very creative terms that have been put forward by operators, and you know, good luck to them. I think the thing is, if you write in something that ultimately devalues the investment value long term, you know, it's a prayer for bad luck that will create a lower valuation going forward on resale. So I think probably answer to your question, no. Can't see it happening.
Yeah, as Vedrana said, Vedrana backed me up, and it funds will pick up immediately, and it will just be a box, and it won't get funded.
Oh, exactly, it becomes unsellable, and it defeats the purpose of doing a lease.
Okay, well, look, I guess that's it. So thank you. Thanks very much to Mariya, to Vedrana, and to Neil for being so honest, open, candid with us. Hopefully we've been able to demonstrate that this is still very much an investable asset class, one of the darlings of the investor sector. You decide. So thank you for joining us, George.
Thanks, Ben. Thanks for moderating.
Thanks for the invitation, Ben.
This session, and thanks Vedrana, Mariya, and Neil. It's been a really interesting look at what is indeed, I think, one of the most interesting sectors for the investment community. As I mentioned earlier in the piece, this entry period for the Service Department Awards is open. More information there, and also in the chat box if you'd like to log on there. If you're interested in sponsoring the awards, please contact my colleague Katie. This is the first in a series of Service Department News webinars. The next one is looking at flexing business models in the sector, and that's taking place in April. My name's George Ciel. I'm editor of Service Department News. If you are interested in being a speaker on one of our future webinars, please do drop me a line. My email address is george@internationalhospitality.media. Thanks for watching today. Thanks again to Ben and the panel, and see you on another webinar soon. Bye-bye.